Hello everybody, we're about to present the financial statement of TODS Group. TODS Group is a holding specialized in the luxury production of shoes, clothing and accessories. Let's now dive into TODS business analysis. The group's organizational configuration rotates around TODS SPA, that is at the heart of the group's organization. Its parent company owns 4 brands: Roger Vivier, under a license agreement acted in 2016, TODS, Fay and Hogan. The group's production structure is based on a complete control of the production chain, from the creation of the collection to production and then distribution of the products. This approach is considered key to assure the prestige of its brands. TODS Group is currently present all over the world. As you can see in the map, the cities are mostly spread inside the European boundaries, followed by East Asia, Americas and some other big cities in the rest of the world. Finally, we have chosen to report the group's mission in order to highlight the company's culture and the idea of tradition, attention to detail, and the quality of made in Italy behind every TODS product. But is this reliability reflected in the values recorded in the financial statement? How is TODS doing from a financial point of view? Let's analyze it.
As a first step, we reported a short income statement in order to have a clear idea about the macro items of this document. Looking at this income statement, we notice a decreasing trend in the period from 2015 to 2018, but as you can see, in 2019 all these values increased despite revenues being the same. Let's find out more. So we notice, oh, wait a second, what's that voice? Can someone get it out?
Yes, sure, Bea.
Thanks, Billy. We can start again. The voice is the non-recurring other income, but due to a Montesano building gain for about 97 million. Moreover, we noticed a decrease in total operating cost and an increase in total amortization and depreciation and in net financial expenses. This is due to the application of IFRS 16. This new regulation introduced in 2019 changes the previous method for lease accounting. From cost, they are now written in the balance sheet and they are subjected to amortization.
I'll take it on from here. Thanks, Bea. During our analysis, we decided to report the income statement without the impact of the non-recurring income, due to the Montesano's building selling. The first glaring thing we notice is that the economic results would have been negative, so the group would have sustained a loss. With these values, we estimate a revenue decrease of 13%, while the EBIT would have changed from 101 million to 3 million. What does it mean? It means that the problem is in the operating part. Moreover, we should point that the values are very influenced by the effects of the application of IFRS 16. This is because the operating cost decreases. In order to show the market share trends of the fashion market...
Stop! Asia, aren't you forgetting something? What's about Roger Vivier being the only firm that is growing within the group? Keep going, please.
Then we have inserted 2 graphs in order to compare TODS macro indicator with the industry one. We can note that, first of all, for the revenues, the industry trend is increasing from 2016 to 2019, differently from TODS. EBIT is decreasing in comparison to the industry average, and TODS profit is decreasing while the competitor's one is quite stable. Finally, this last chart of the sector shows the average macro values in the income statement of TODS in comparison with the average industry. These values show the relationship between EBIT and the profit with the revenues. We wanted to highlight the lack of TODS efficiency on costs. In fact, as you can see, drop from revenues to EBIT is 89%, higher than the average industry's one. That is higher. In a nutshell, we can say that, first of all, the group is operating worse than the industry average, and secondly, the macro indicators of the group have been decreasing.
Now, let's start with profitability analysis and say hi to our shareholder Bob. Hi Bob! The return on equity represents the return that shareholders get at the end of the period from an economic profit. As we can see in the graph, the ROE values oscillates from 12% in 2016 to 4.48% in 2019. So, remembering that in 2019 we are also considering the Montesano building selling, it is clear that it is a very negative trend, and is also confirmed by comparing these values to competitor trends. Anyway, this comparison is not very accurate, especially when companies have different characteristics in terms of structure, sales and brand values, in particular in the fashion market, where brand value represents a key source of competitive advantage. We would like to show you, through this QR code, the model that we have created in order to do a more truthful comparison. Since it is quite long, just pick your phone, scan QR code, and enjoy our model. As it is clear in the graph, only in 2015 and 2016 TOD's return on equity was higher than fair ROE. It basically means that an investment in TODs was more profitable than a general investment in the market, and so we can assume that shareholders were satisfied at least of one of the three elements of comparison of return on equity. About return on investments, we can say that the industry trends has been swinging until 2018 and aggressive in 2019 due to the collapse of Ferragamo return on investments, while TOD's 1 is pure decreasing, passing from 19% in 2015 to 6.5% in 2019. So, these values are not satisfactory because they are both under competitors' average and systematically lower with respect to the past. Return on sales is the indicator that measures the efficiency of the company. TOD's return on sales is decreasing in 2018 and increasing in 2019, but is always under the sector average and, from 2017, under the satisfactory threshold for a manufacturing company, that is 10%. The value of ROS is clearly down in 2018, essentially because of the decreasing in EBIT. This is basically due to the increasing the operating cost. Anyway, this was not followed by an increase in revenues that, according to the values of previous year, should have been about 1 billion. The difference between the expected value and the real values is about 50 million, that is in fact registered in the inventory. Finally, we have calculated ROCE that tends to be higher than ROE because it is calculated through the comprehensive income. The 2016 value stands out because of the capital increase due to the acquisition of Roger Vivier. Then we found RNOA and profit margin. They are very useful in order to compare different companies with different debt structure. They are in fact calculated using NOPAT instead of EBIT, so we have an efficiency result net of taxes.
Asset turnover measures the effectiveness of the group. Total asset turnover can be deemed satisfying because it is lower than one threshold since 2016. However, we had to a point that in a fashion group where the brand value and so the tangible asset have an important weight on the net operating asset, it's quite understandable to have the asset turnover lower than 1. As we can see in the graph, in 2015 the asset turnover was 1.38 and the following year it has decreased for the acquisition of Roger Vivier. That brings the total value of net operating asset for more than 400 million. Calculating the fixed asset turnover, we figure out the effectiveness of the operating asset. In 2015 we have strong result. Fixed asset turnover is higher than 2. And this means that our fixed assets are capable of producing a stream of revenues that is twice their values. As we can see, the trend for the following years is negative, but the values is still satisfactory until 2019, when fixed asset turnover is registered to be 0.81, which is lower than the minimum threshold we consider acceptable. Coming to our final consideration over the company profitability, we conclude that TODS has serious problem. The first problem is the lack of efficiency. As the previous chart showed, the cost component is well over 80% of the revenues. It is clear that jeopardizes the economic result available for shareholders. We have to say that the lack of efficiency is always shown in the considered period, but the drop in effectiveness triggered a big warning only in 2019. In fact, even if the asset turnover has been under the threshold during the years 2016, 2017 and 2018, it was compensated by the fixed asset turnover, which registered positive values. It's with the new IFRS 16 regulation that in 2019 also the return on fixed asset was badly damaged. Plus, if we consider that the 2019 income statement was saved only by the selling of the Omotesando building in Tokyo, the scenario gets even worse. Conclusion, it's not a great time to be TODS shareholders.
So, let's start with the solidity analysis. These two graphs represent the percentage of fixed assets covered by equity or long-term obligation. From a solidity standpoint, TOD's situation is very positive because, as you can see, until 2019, equity was enough to cover the fixed assets expenses. Since the right chart is composed by the sum of equity and long-term liabilities, we will have an even greater result. Let's move on to the second level of the solidity analysis. We are about to analyze the debt-to-equity structures thanks to these two charts. In both of them, we can appreciate how the debt is substantially lower than the equity value. In particular, until 2019, the equity was twice the debt value. From a solidity point of view, this is obviously very positive, while from a profitability standpoint, we can state that the situation is optimal from debt holders more than shareholders. The reason is that, since the company presents a large amount of equity, debt holders have a greater guarantee that their credit will be reimbursed. Shareholders, instead, will have less dividend per share. The theoretical optimal value for debt-to-equity ratio is considered to be 1. TOT's values are much lower due to the large amount of equity. From a solidity standpoint, the values from this ratio are astonishing, but again, they are not optimal for shareholders' interest, as they would love to have a bigger debt financing in order to distribute more dividends per share. From what has been said, it emerges that the group has a very solid financing structure.
Thank you, Alberto. Now we will proceed with the liquidity analysis, which aims to measure the financial equilibrium in the short term. Let's start with the first level of analysis. We calculated 3 ratios. The first one is the current ratio, which verifies if the group is able to repay liabilities that expire within the next 12 months using its more liquid assets. Considering 1.8 as the minimum value, we can say that the group has good current ratio values. The quick ratio does not consider inventories because it's the least liquid asset among the current ones. Values greater than 1, as in this case, represents the company capability to meet the short-term obligations without selling inventories. Finally, we have calculated the cash ratio. The values you can see in the bars representing the percentage of liabilities covered by cash. In terms of liquidity, they could be considered excellent values, since they are higher than the threshold of 0.2%. But in terms of optimal distribution of assets, cash is a non-operating item, and such should be kept with minimum security range in order to maximize profitability and effectiveness. The second level of liquidity analysis consists of calculating the duration of the working capital cycles. It expresses the number of days in between the cash out from payables and the cash in from sales. In TOT's case, this is pretty high and increasing over time from about 4 to 5 months. This trend is obviously negative because it means that the period between the payment of raw materials and collection of receivable is increased by 23% in 4 years. Such a high working capital duration can explain the very high liquidity levels seen previously. At the end of the day, we can conclude that Jane is a pretty happy debt holder. Aren't you, Jane? Yes, you are. Now, talking about cash flows, we can analyze cash flow from operations, investing, and financing. Cash flow from operation gives us an idea about the real sum of money that the company has created through its operating activity, through its core activity, since we add back all the non-monetary expenses to the profit of the year. In our cases, cash flow from operation trend is negative, in line with the drop of profits. In 2019, is higher due to the IFRS effect on amortizations. Cash flow from investment, though, shows the amount of cash that was invested in the company or that has been disinvested. In our case, we can appreciate how the 2016 value is high due to the acquisition of Roger Vivier brand, and in 2019 for the new provisions set for IFRS 16. Finally, cash flow from financing represents the net amount of money that the company asks to its stakeholders. Bob, would you mind investing some money? Fine, we will do it ourselves. Jane, 10% rate. Are you in? That's how you make money. A growing company usually presents a positive cash flow since it always needs money in order to finance new business activities. This is shown again during years 2016 and 2019, with the same exception for the second year. Finally, using the residual earnings model, we can estimate the actual value of the firm based on the forecast earnings. In order to find the forecast earnings and dividends, we use the Bloomberg platform, in which we found the future expected values of EPS and DPS estimated until 2022. We noticed that the ROE of 2019 is lower than the fair ROE, and this would imply residual earnings to be negative. We have analyzed 3 cases. First scenario implies no extra credit profits after 3 years, where the actual value per share would be equal to 22.12. The second scenario implies that the residual earnings remain constant after the 3rd year, and the actual value per share would be lower, just 1.80. Last scenario is the one with a growth rate of -3%, and so following the pre-trend degrowth. Here we have a negative value per share equal to -19.89. We can finally say is that the company is very solid, has good reserves of liquidity, and is very likely to meet their obligations. On the other hand, TOT's shareholders will not be so comfortable knowing that the forecast company value is very, very low. Thanks for your attention. Thank Bob and Jane for the special participation.